What it do, fam? I hope you enjoyed that week of moderate stability. It's an improvement to the weeks prior, but we should probably expect more volatility going forward, as we'll soon see. You're watching Sekitor, and today we'll be reviewing the Korea Development Institute's economic report for the month of October, released on the 7th of this month. Now, before we continue, we'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. For that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether to take up a position on any stock mentioned here. Want to know how? Well, if you scroll down a tiny bit and hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. That being said, let's get to it. Alright, so for the sake of brevity, I'm going to choose 3 key takeaways from the report to touch on and give us the most efficient summary possible. For one, with COVID entering its 3rd year, the country's new daily infections still clocking in over 1,000, and the resulting prolonged lockdown and social distancing measures, face-to-face and in-person services are still suffering heavily. 2. Supply lines are still strained, putting further pressure on global trade and manufacturing, which has led to a dampening in market sentiment as manufacturing sentiment wanes. And 3. The jobs market is still looking bleak, with decreased growth and big losses in face-to-face services, continuing a trend that we've seen growing increasingly dire over the course of the pandemic. Now let's start at the top, because the fish rots from the head, if you know what I mean. So while the coronavirus is quietly entering its junior year and starting its college prep courses in addition to picking up a part-time job to make ends meet, the effect that it's having on both the real-world economy and the habits of everyday people continues to put a strain on large swaths of the face-to-face economy. Now, what do we mean by face-to-face economy? Well, in August, employment in the accommodation and food services industries continued their employment pullback from the month before. They increased a loss of 12,000 to 38,000 jobs, while the arts, sports, and rec-related services similarly increased their decrease from a loss of 28k to 43k jobs in August. Still, if we look at the overall rate of job loss on a year-over-year basis, we can see that the changes that we're experiencing now are fairly mild when compared to the changes we saw at the height of the pandemic. Now, keep in mind that reading this chart that way is extremely optimistic, since the low base of last year will necessarily affect how this year's numbers appear due to the low base effect. Still, I guess the biggest bright spot that we can find here is that generally more people are employed right now than were employed at the same time last year, and that includes the sectors that have been waning recently. Now, looking at the same chart, we can see that manufacturing, which wasn't really affected by the coronavirus in the same way as the rest of the market, has taken a downturn over the 3rd quarter. This change can be accounted for by considering the second point of focus, strained supply lines due to global trade pressures. This is rooted in a number of factors, like the US and its allies ramping up its trade war with China, leading to halts in production as Australia withholds coal and other raw materials necessary to keep their factories open. For firms on our end, like SK Hynix and LG Chem, that rely on their factories and manufacturers in China for parts of their business, this implies a reduction in output in the short term. Another issue is that of freight rates and jam-packed ships that have pushed the SCFI straight through whatever imagined ceilings importers and exporters may have placed on shipping rates. Even with many of the world's largest shippers putting a cap on their cargo prices, and a recent decline on the SCFI spot rates, worker shortages at ports, and increased import-export demand on the back of this goddamn plague are making sure that any and all hope for a return to normalcy at sea is pretty far off in the distance. Throw in a little bit of an oil price and raw materials boom, and with the quickest of the quickness, we find ourselves in a tough spot for world trade. As a result, we've seen a 4-month decline in daily exports from June through September, and a similar decrease in the business sentiment index for futures tendencies, which is just a complicated way of saying that business people are really pessimistic about this. Now, this pessimism, combined with new and stronger restrictions from the FSC in the tech sector, as well as worries about inflation both here and abroad, have all boiled together into what has revealed itself to be really ugly stock market movements for much of September and the first couple of weeks of October. Now, I guess we've already covered the jobs market earlier, so we're going to close with this: the government's new policy of living with COVID, which kicked in this past week. Now, with COVID vaccination rates increasing in Korea and around the world, Korea has begun preparing to accept more foreign travelers into the country in a move that would effectively treat COVID less like the Black Plague and more like a seasonal influenza. That is to say, although the capital and its surrounding area will still be under level 4 restrictions, the rules applying to those restrictions will change, both in the capital and abroad. Specifically, maximum group sizes after 6 p.m. will go up from 6 people to 8 as long as 4 members of the party are fully vaccinated. In other areas, the limit will go up to 10 people with at least 6 fully vaccinated group members. Generally, with over 60% of the population fully vaccinated and over 3/4 of the population partially vaccinated, the government appears to be comfortable with their capacity to handle the virus while incrementally reducing the strain on the services that we mentioned earlier. Now, whether or not this plan is a good idea is another video for another channel, but it's clear that the government sees the light at the end of the tunnel and they're determined to get us there as quickly as possible. Alright, that's it for me. I know I said we'd talk stocks again soon, and we will, I promise, it's coming. There's just a lot of really interesting stuff going on, both within our market and around the country. Until then, though, stay tight. Oh, just a reminder, on the 25th and the 26th, so the Monday, Tuesday of this week, i.e., I guess today as of posting, and tomorrow, Kakao Pay's IPO will be taking subscriptions. Alright, peace.